Hello and welcome to KYC. I am Sharad Dubey and with me is Mahima Vachrajani, and the company today at KYC is none other than LG Electronics. A very big issue, IPO recently listed, and of course the earnings. That's also something which we'll be looking out for. But in our entire show, Mahima, we'll be looking at why we're actually calling this company right now. And first question, of course, is what led to a muted quarter? Is it a sectoral specific theme or is it just company specific? We'll be going after that. What's the top line growth? Will it sustain to continue, going ahead in a sustainable manner? Margins, will they be sustainable between 12 to 13%, or will we see some pressures going ahead? Also, promoter stake, that's expected to come down from 85%, and as per SEBI rules, it has to come. And market share gains, a lot of competition the domestic players are having. But just give us the details about, in our segment, about the company, what the company is all about.
Right, so I think everybody is familiar with the brand of LG Electronics, right? It was established in 1997 in India and focuses on various consumer electronics and B2B business as well. With regards to the business-to-business segment, the two business segments that it has is home appliances and air solutions, which is the first one that has your air conditioners, refrigerators, microwaves, ovens and washing machines. It also has something like a dishwasher, compressors, HVAC, water purifiers as well as air purifiers. And the other segment, that is home entertainment, that includes your televisions, audiovisuals, monitors as well as personal computers. This is the overall view of the two segments that it operates in. With regards to where manufacturing unit is concerned, the manufacturing unit at Greater Noida and Ranjangaon, Pune is there and has the capacity to manufacture LED TVs, air conditioners, commercial air conditioning system as well as washing machine, refrigerators and monitors. So it has a good setup in India with regards to where their products are concerned and manufacturing unit is concerned.
Well, that's true. A lot of products are there. But we also have a lot of criteria. In our KYC segment, there are almost 8 parameters where we judge a company. And I'll just quickly go through that. That includes income statement, balance sheet, cash flow, return ratio. These are the numbers. Also shareholding street cred, which is nothing but your stock reaction coming in. Of course, it's just 1 month, you could say. So the time is less. Valuations and the street coverage, especially from the analyst community. So these are the important rating parameters. But first parameter is income statement. What are you looking at?
So, Sharad, it's been a strong growth for LG Electronics when it comes to the top line as well as bottom line. If you take a look at the past 3 years from past 4 years from FY22 to FY25, the overall 3-year CAGR for the top line has been at that 13% mark. Even in terms of EBITDA, it's grown over that 22% mark from FY22 to FY25. So essentially, from a 16,800 crore of top line, they've gone to 24,300 crore of top line in the past 4 years. Even with regards to where the net profit stands, that has also grown at a CAGR of 22% from a 1,200 crore, around 1,200 crore in FY22 to that 2,200 crore in FY25. And that CAGR has been at 22%. Margins have also been steadily improving. Of course, this quarter they had one-offs, which has led to a margin downtick. But overall, if you take a look at the margin trajectory, that has increased from 10.2% to 12.8% in FY25. If you take a look at the Q2 numbers, revenue was hardly up 1%, EBITDA was down around 28 odd percent. Margins came in at around 9% versus that of 12.4%, and net profit was also down by about 27%. But this quarter was largely impacted by the GST rate rationalization, where they had a lot of channel inventory in place, and the consumers were waiting till 22nd of September to buy a lot of consumer electronics once they get cheaper in terms of, especially in terms of ACs and TVs and dishwashers. So that has impacted the quarter, and seasonally also this quarter is slightly weak. Quarter 3 is going to be a festive season where we'll see a pickup as to where volumes are concerned. In terms of segmental performance also, home appliances and air solution, growth was flat. GST rate change temporarily, of course, influenced the purchase timing, and market share, however, has seen a growth and now stands at around 43.2% mark. In terms of home entertainment, the segment grew around 3%, and the OLED market share also inched up. So that's the entire view as to how the income statement for LG Electronics is looking like. It's a thumbs up for sure.
Well, that's pretty interesting. Apart from that, even balance sheet is reflecting a lot of strength, Mahima. If you look at it, the book value that has also jumped up, equity numbers are stable, but the number which you'll be looking at on the higher side, that's the cash and bank balance. There is a significant uptick coming in from FY24 to FY25. The company is shoring up for their expansion, and that's what the management had also earlier stated during their IPO. So overall balance sheet is stable and it's looking for internal accrual-led capex also, it seems, because the number is very high on the cash front. So from my side, it's a thumbs up when it comes to the balance sheet.
Right, absolutely. I think 3,700 crores of cash where FY25 and now the IPO proceeds will also come in, and we'll have to see as to how this capex is being utilized because their ratios have also remained very strong. We'll come to that point, but cash flows right now, you know, overall, if you take a look at the cash flow from operation number, that has slightly come down as compared to where it was in FY23 from a 1,871 crore to a 1,654 odd crore in FY25. So slightly lower where cash flow from operations is concerned, versus that of EBITDA growth that has nearly doubled in the past 3 years. So the ratio of cash flow to EBITDA has come down from a 99% to that 53% mark, translated to a lower conversion of that cash flow to EBITDA, which is why we've given a neutral rating when cash flow is concerned. But at the same time, in FY25, they've turned net cash flow positive, which has not been the case for FY23 or 24, and that's a whooping 1,500 crores. So considering all of this, just because cash flow from operations to EBITDA, the conversion has not taken place and has been, you know, coming down, we've taken a conservative approach here and given it a neutral rating.
That's pretty interesting. Earlier, Mahima, you had mentioned about the return ratios while we were discussing the balance sheet, and she's right. The return ratios have outperformed, you know, their own industry numbers also. Return on net worth, that has seen a bit dip, but look at ROC. This is an important factor to actually factor in. For FY25, it's coming in at almost 43 odd %, a slight decrease coming in, but it has, you know, upped up its guidance, you know, from FY23. So H1 numbers also would be on the elevated levels. That's what we are expecting, and of course the company has given its numbers also. So net the return ratios have improved, and you need to see a long time frame to give these numbers and our ratings. And from my side, it's a thumbs up when it comes to the return ratios.
Right. So I think return ratios we'll also have to see as to how FY26 pans out, right? Because if they're taking up capex, there will be a slight dip in the return ratios. But anything above that 20% mark is a healthy, you know, ratio to consider for ROC, and hence we've, you know, given it a thumbs up when ratios are concerned. But shareholding pattern, you know, not much of a data in terms of where shareholding pattern is concerned, because this is just as of October when the company got listed. Promoters are holding 85% as of now, the parent company of LG Electronics per se, and you know, at 75% mark anyhow they will have to come to, and 25% is what the limit they'll have. So we'll have to see as to whether it will come from that 85% mark to just that 75% mark, which is the overall legal requirement, or will the parent company actually dilute further stake? That will be something to watch out for, because recently Whirlpool, we saw as to how the promoters of the company had sold eventually stake in Whirlpool, considering that they wanted some cash out from Whirlpool India. So that is something that we'll of course keep an eye on. FI holding at that 3% mark, so nothing to compare to right now, but we'll have to see if this continues to grow for something like an LG Electronics. 4% is DII and 8% is around public. So the promoter, you know, coming down to the legal range of that 75%, whether it will be covered by FIs or DIs is something that we'll have to watch out for. So considering, you know, there are some questions that need to be answered as to who will buy next. We've given it a neutral right now.
Well, that's pretty interesting, and DIs have been buying post the listing also. So these numbers will be reflected in the last quarter. So that'll be pretty interesting. This number might change for the DIs front at least. But Street Cred, which is of course having the entire stock price movement, not much to share because this was just listed stock last month itself. It listed with a bang on 50% listing, but from IPO price, you could say it's up 43%, but from the listing price, stock has not done much. So right now, of course, the timing is very small. So it's better to have a neutral stance and give the company more time so that we can judge the company on their stock price movement and the street trade follows. So it's a neutral impact coming from my side.
Valuations is the next one. We've been talking about valuations a lot since the company, of course, came out with its IPO. This, compared to its peers, is fairly priced. There's no question there. And that's one of the reasons as to why it garnered a premium of almost 50% while listing as well. Because as compared to something like an LG Electronics, we've seen new age companies come at a very heavy valuations and then see a muted listing, right? So the kind of premium it got listed at was justifying the valuations at which it was sitting at. FY27 forward PE stands at around 29 odd times. Now this, as compared to something like a Blue Star at 46 times, Havells at 45 times, Voltas at 40 times, Whirlpool at 27 times, Crompton Greaves at 25 times, and overall, if we take a look at the Samsung global valuations, that at 11 times. But considering the listed peers in India, it is fairly and cheaper as compared to where the peers stand. But still, just taking a conservative approach here as well, because 29 times is not cheap, right? FY27 forward, and considering if they continue to grow at that CAGR of 13%, slightly might turn out to be expensive. So that's why we've taken it a neutral approach and given it a neutral rating.
Mahima, the company size is very big.
Very big.
So the expectations of massive growth should be limited for most of the viewers and even the investors who are there in the stock. But the street coverage, of course, we saw almost 10 calls coming in, 10 analysts are tracking this, and all of them have a buy rating also from the current levels as well. So we are expecting that more analyst coverage comes so that we understand more, and because of that, we need to give more time frame to it. So right now, it will be just a neutral aspect coming in from our side. But let's just get all the rating parameters again and revise the total KYC rating which me and Mahima are giving for this stock. Of course, let's get out the income statement. We're largely given a thumbs up for income statement. Mahima pointed out, of course, the Q2 numbers were questionable, muted set of numbers coming in. Balance sheet very strong. Cash flow neutral. Return ratios, Mahima had also mentioned there was strength. Not much happening here in shareholding, street trade valuation, and even street coverage, and this is because of a very small time which we have taken frame, but overall it comes at 5.5 out of 8
without any thumbs down, right?
Exactly.
Without any thumbs down.
Mahima,
and we've taken a very conservative approach.
And it's after conservative, it's coming at 5.5, and this is like a higher band average when we come with our KYC rating, so that would be pretty interesting. But Mahima, you had a conversation also with the management. What was that entire tone of it?
Right. So, I did talk to the management of LG Electronics. I spoke to Sanjay, Chitkara as well as Atul, Khanna. And I started by asking Atul with regards to this quarter particularly, because this quarter is seasonally weak and of course impacted by that GST transition. And I started by asking him with regards to what were the hits and misses this quarter. Listen to what he has to say.
If you recall that FY26 began on a cooler summer impact, where consumer demand was also little subdued. There are geopolitical uncertainties, Indo-Pak war, tariff tensions, right, which impacted the industry, and the inventory level goes up. When we started the Q2, the inventory levels was the trade in the on the higher side, and then the GST rate cut announcement begins on 15th August, and which has also deferred some decision making by the consumers and the partners. And the actual implementation started from 22nd September, almost a week before of quarter end. Though we have seen that upswing in the sellout in the market for the premium product category after that, and though during this quarter also there was a high inventory levels, whereas which we foresee is normalizing after that, and particularly our revenue for Q2 was almost 61.7 billion INR with a year-on-year growth of only 1.0%, whereas the margins was little contracted because of some external factors where we have absorbed the cost of through our go-to-market initiatives and consumer promotions offer to boost the partners' momentum and our trust of our consumers, which we are foreseeing that the momentum is building up, uh, whereas our natural revenue growth almost 1% up, which also impacted some our fixed cost burden also. And we have seen some global headwinds also, which and rising commodity prices. After that, some corrective actions have been taken by slight increase of some prices in the washing machine and refrigerator. And we are foreseeing that due to this upcoming festival has just closed, and there is a upcoming wedding season, and then the winter season is coming. And most important part is our for the air conditioner business, where new BE ratings are coming in effective January 26,
Correct.
where there would be again a price increase impact, which will be neutralized with the GST rate cut. So there is a good period for the month of November and December, where the we are foreseeing that air conditioner business will boom.
Okay.
This
So Sanjay ji, then I wanted to understand, because you did mention, right, that margins had taken a hit because of a one-off. You also have cost of raw materials slightly going up. By the end of FY26, I'm understanding that this is just a one-off in this quarter. By the end of FY26, you'll be able to maintain that 12 to 13% of margins?
See, we never pursued the short-term margin tactics. So our strategy is always for long term, because in any business, the market share drives the revenue and revenue drives the profitability. What Atulji has mentioned, I want to add, during this period, we improved our brand strength and we improved our market share. If we see, we improved our market share for refrigerator 1%, TV 1.4%, and air conditioner by 0.5%. So this way, we have already expanded that advantage. As Atulji have mentioned, we have also rationalized our promotional intensity, taken a price increase also, and we should be mindful that in quarter two, almost 1.5 month was there for this GST transition. In fact, in just 1.5 month, we covered the last year turnover, registered a 1% growth, and our margin, which we registered, is 8.9%, which was 5.48 billion, and it is still industry leading. So that way, there is absolutely no business issue, no company's fundamental issue. It was just a timing shift due to GST.
Understood. And I think that should pick up in Q3 because of festive seasons going very strong this quarter. And that's the general outlook that I've got from analysts as well. But with regards to, now that you're listed, you'll be able to give us some perspective and your investors some perspective with regards to where FY26 will end. You've grown at a very strong CAGR of, the 10 to 13% mark in terms of your top line, over 20% in terms of your bottom line as well. Do you think that CAGR will be maintained this year as well?
See, if we go to our history, our CAGR growth is 13.1 from financial year 22 onwards. And we have been registering a double-digit growth, double-digit EBITDA margin.
Correct.
Being a sales leader, definitely, I mean, our effort would be that we catches that margin level and growth level. But since half of the year has already passed, and to cover up I mean, this year have been was a very tough year, and but we are very cautiously optimistic for the future, and definitely the better time. We have already passed the toughest phase. So the toughest phase is already over, and best is yet to come. That's what I cannot give you the forward-looking number, but
Sure.
definitely things will normalize.
Sure.
Inventories are getting normalized,
Sure.
and you will see a better results in coming time.
Okay, so I understand that you cannot give me a forward-looking statement, but when you say that you'll be cautiously optimistic, that 13% that you mentioned that you've grown from at a CAGR of 13% since FY22, do you think a double-digit growth on the top line will be possible in FY26 as well?
See, I again repeat that. See, I handle the sale, and I am a sales leader. So my always efforts are that we grow and we meet the expectation of our investors, our management. So we are doing a lot of hard work in the market. But the best thing is we are getting a positive demand signals from the market, and there is a healthy pipelines are there. So there is not a structural issue with the market. It was just a timing shift. So, I mean, this indicates the things are positive. As Atulji mentioned, next year the new star rating guideline will come, and we are preparing for that. The best thing is after GST cut, the affordability of our products have improved. We faced that 1.5 month tough month when the buying deferred, but now the things are normalized. Customer sentiments are good, products affordability is good, so things are very bright and optimistic.
Understood.
I will add, Mahima, I will add. Actually, our organization focus always remains on the long-term segment level strategies
Sure.
that support to sustain our margins as well. And our product portfolio is having a good combination of premium segments and with a less pricing competition, where we are offering differentiated customer experience and product innovations.
Sure.
As we have launched LG Essential series also
Yeah.
in the month of October, which is giving a good early traction with a very limited SKUs, but we would be coming up with more SKUs in the increasing the family size. So we can say our driving focus would be always sustainable growth with a profitable, meaningful venture, even in the mass premium segment, and we are securing our number one position in both premium and volume categories.
Okay. Okay, fair enough. Sanjay ji, with regards to where the market share is concerned, you've gained market share where home appliances is concerned. What has led to that growth? And going forward, right now, if I'm not wrong, the market share is around 43, 44 odd percent. How early do you think you can reach that 50% mark?
If you see our side by side market share, it is nearly touching 44%. OLED's market share is 62%. So we will definitely try to benchmark these market share, but we should also be careful because this market is highly competitive, and we respect our competition. But the one good news is in September month market share result, our brand strength was its peak, and we registered a ever time highest gap with number two player. In TV, the gap was 6.7%, which is historically highest, and refrigerator it was 6.2%. For side by side, it was roughly around in a range of 12 to 13%. In washing machine, 15-16%. So TV case and refrigerator case, historically highest gap we have registered. Air conditioner case, we were number one for inverter air conditioners previous last year. But this year we have become overall number one also, and created a gap with number two player.
One last question to you, Mr. Atul. Right now, your promoter holding is at 85% mark, and eventually you'll have to bring it to that 75% mark. How is the transition going to be like? Any plans in place?
So I have mentioned that we will follow the CB guideline in this, and as per CB guideline, up to 25% we can do. But for this, we have been given a period of 3 years.
For a period of 3 years. And you'll be looking to dilute that 25% completely, or you'll just bring it back to 75% and let it be at that?
The board will decide about this. I mean, I cannot disclose it right now in
Sure.
this meeting. We are focusing on our business growth and profit for next quarter.
That's a pretty interesting take, and thanks a lot, Mahima, for interviewing the management. And management's tone was overall bullish. Of course, there was a seasonality also. What are your, key takeaways from that?
I think the key takeaways, rather than being very bullish, I think they said that they're cautiously optimistic because first half of FY26 has already gone, which is, second quarter especially impacted by the GST rationalization seasonal impact as well. So we'll have to see whether they actually grow at that 13% CAGR this year as well. The second one is the takeaway of Q2 being impacted by GST transition, of course. And third one is that market share gain is something that they're focusing on and will continue going forward as well. So this, of course, is a bullish commentary coming in.
So, will this be a third quarter also? We'll see some kind of up move?
Yeah, so third quarter being a festive season, and we'll see the Diwali sales also translate into, I think that's going to be the strongest quarter for them.
Okay, just let's just revise the KYC rating. And you see income statement, balance sheet and cash flow. We have given almost 2.5 out of it, and return ratios have been good. 3.5 already here. Not much here, because of the timeline which we had actually discussed most of these parameters, and overall, Mahima, it is 5.5 out of it. So strong numbers coming in, but management's commentary, as you stated, is still cautiously optimistic for FY26. So this is all we are giving you at this KYC show. Thank you very much and stay tuned to NDTV Profit.